All right, we're back. Let me take 10 seconds to explain to you that the curbs in means that program trading by computer is limited. And you may ask, well, what's the significance of the, we were up 220 or 250 points. It's not based on the Dow. That adds to your confusion. It's based on the New York Stock Exchange Composite Index, which almost no one watches. But that's what determines whether the curbs come in. If that moves 190 points, the curbs come in. So that's why the curbs came in. It has nothing to do with whatever level the Dow is at, but obviously there's a correlation. Our next guest is calling this a crisis of confidence. He's playing this market with large caps. Joining us from Cleveland, home of the Rock and Roll Hall of Fame, a new face to CNBC, Richard Barone, chairman of the Ancora Group of Companies, where he manages about $1 billion in assets in a variety of investment strategies, including the 5-star Morningstar rated Ancora Income Fund. Good morning. Thanks very much for being with us.
Well, good morning, Mark and Aaron. What a week.
What do you think of the Fed's move today?
Oh, I think it is exactly the right thing. The Fed is taking baby steps here. I think ultimately it's not going to be enough. I think the Fed's really going to have to become more vocal on what it intends to do, and that is provide liquidity throughout the system.
Well, as Lyle Gramley, who was with us just a few minutes ago, pointed out, if you read the Fed's statement today, you really have the equivalent of a change in bias. They are now talking about the threat to slowing of the economy rather than inflation. So, I mean, for those who want a rate cut, that's pretty good news, isn't it?
Well, it's good news, but I think the Fed did exactly the right thing. They didn't fool around with the targeted Fed funds rate. They went right to the discount rate. Discount rate is much too high in this time of crisis, and the Fed did exactly the right thing by lowering it.
I want to get a sense, though, of, all right, they did exactly the right thing. This is what was needed to avert a near-term sell-off, but yet everybody continues to say this is a drop in the bucket, this is a step, this does not solve all of the lending practices that were going on that were maybe too loose. It doesn't solve the worries about people paying money back. It doesn't solve any of that. So I'm trying to get a sense of how big is this step?
It's a baby step. It's only a baby step, and the Fed's going to have to take much more action in the next 2 or 3 weeks.
2 or 3 weeks. Now, I know we're obviously 2 or 3 weeks. I mean, is that September 18th we get a Fed cut, or are you talking about they need to do more, and maybe it's not necessarily a Fed cut, but something else in the next before that?
I think they're looking to the time when they are going to have to make a decision about a Fed cut in September, and I think they want to build the crescendo till then. In other words, a discount rate cut, perhaps another discount rate cut in the next week or two, and maybe some jawboning into the market about the fact that they will provide liquidity if and when needed.
Well, interestingly, Rick Santelli was telling us earlier that this move has had the effect of, in the Fed funds futures market, of reducing the expectation that the Fed will lower rates on the theory that having done this, a decline in the Fed funds rate becomes less necessary.
Well, that's true. If this works, and I don't think it will work, I think they're going to have to make additional moves. They have another 0.5%, perhaps another whole percent ability to cut the discount rate here. And they have the ability to provide or do more talking about providing liquidity into the markets. They haven't done that yet. If you look at what they've done, really essentially they've put Fed funds into the market and cut the discount rate. These are very, very tiny steps, and I think they're going to have to do a lot more to alleviate this crisis that we're facing.
All right. Thank you very much, sir. Appreciate it. Richard Barone, our guest from Cleveland. One note, by the way, if I may, Aaron, about these program trading curves. They come in when the NYSE Composite Index has moved 190 points up or down from the previous day's close.
I didn't realize
and that happened. They go off when the NYSE Composite Index returns to within 90 points of its previous close. So even though we've now come down, the curves are still in.
That is very interesting because the curves are confusing.
Yes, and to base them on an index that only very few people look at it is a little confusing.
All right, David,